Hello and welcome, everyone. On behalf of Questrade Inc. and WisdomTree Asset Management, I'm excited to welcome you to today's webinar on building a balanced portfolio with ETFs. Just a couple quick housekeeping items before we begin. First, today's webinar will be recorded, so please watch your email inbox early next week or later this week, and we'll email you as soon as the recording is available. And second, we will be saving some time at the end of today's webinar for Q&A, so feel free to submit any questions through the chat window, and we'll ask them on your behalf at the end of the webinar. But feel free to submit those throughout the webinar as you think of them. And with that, I'm excited to introduce you to Jeff Weniger, Asset Allocation Strategist from WisdomTree Asset Management, and today's presenter. So Jeff, take it away.
Thanks, Jeff. I appreciate it. From one Jeff to the other, I suppose. And thank you, everyone, for dialing in today. The title, Building a Balanced Portfolio with ETFs, we'll go for about, it depends on how excited I get, right? We'll go for about 25, 30 minutes or so, discussing the trends in the ETF business, really, the advantages of ETFs relative to mutual funds and so forth. And then, as Jeff stated, we'll open it up to some Q&A at the end, should you have any points of clarification, I suppose. So coming right into the first slide here of the presentation, really, what are the major components of ETFs, the things about ETFs that make them so advantageous? Why is it that ETFs have managed to take essentially about 10% market share relative to mutual funds, essentially from going from 0 to 100 miles per hour through the years? ETFs now in Canada are pushing about 140 billion CAD in AUM. Mutual funds are at 1.4 trillion. And you'll see later on in the presentation some of the sheer size of the ETF business globally. But why did ETFs take off so much? They're a quarter century old, but it's been in recent years we've seen so much money coming in. And it's because there's some clear advantages that ETFs have relative to mutual funds. First off, you have intraday liquidity, and that's a pretty big deal because the problem with mutual funds is that, let's say you come to the conclusion and it's the middle of the morning that you want to get into a mutual fund. Well, whether you like it or not, you get 4 p.m. Eastern Time net asset values. That's just the nature of the mutual structure. Whereas an ETF trades on an exchange, just like a stock. So whenever you're seeing on BNN or CNBC, you're seeing at the bottom where all the stocks are coming across, and you'll see something like a WisdomTree ETF come across or some other ETF. Those are all stocks and ETFs. They trade just like a stock would. And so there's some clear advantages to that. And furthermore, ETFs in general, most ETFs, some are now doing active management, but they track indexes like commodities or bonds or stocks. And so there's a transparency there that we'll talk about in the coming slides. Now, as I stated, ETFs have kind of taken the investment world by storm through the decades, and we've been very proud of that. WisdomTree is a pure play ETF company. It even has a ticker symbol, which is WETF. And it's because, essentially, if you take a look at what is happening, the sheer size has now come to a point where we've reached critical mass. I think that in the early days, people weren't really, well, what are these ETFs? What are they doing? There's not a lot of money. But now in recent years, we've gotten to the point where you reach the $1 trillion mark, and then you reach $2 trillion in global ETF assets. And people started to realize, okay, this is a changing of the structure from a mutual fund structure to an ETF structure. And now we're pushing about $5 trillion, and you reach this critical mass where people started to investigate and realize, oh, these things have a lot of advantages and not very many disadvantages to speak of, in fact, relative to mutual funds. Now, if you take a look at some of those key advantages of the ETFs relative to mutual funds, for example, there's the transparency. So suppose you came to WisdomTree, you like the WisdomTree ETF. And this is not unique to WisdomTree. You can go to any ETF provider's website because you're tracking an index of stocks, let's say, everything's laid out for you on the website. So you know that you own such and such ETF, you go to the website, and that ETF is 2.57% XYZ Corp. You know that right there. It's right there on the website. And then you go on tomorrow, and it's no longer 2.57%, it's 2.59%, let's say. Full transparency. You always know what you hold at any given time, which is more than what you can say with a mutual fund manager. So it's a nice advantage to have, and that's kind of one of the things about portfolio construction is it pulls the cloak back on any obscurities or any confusion you may have had with an active mutual fund manager where you think you know what you own, but maybe you don't. It also puts more power in your own hands. There's also some cost efficiencies, which cannot be underplayed in the slightest. This is probably the main draw of ETFs. And I'll give you an example later on in the slide deck. And tax benefits. This one has been always pretty appealing to me. Before I came to WisdomTree, I came over to the firm about a year ago. I was on the other side of the table. I was a client in a private client situation. I was an asset allocation strategist there as well at one of the big Canadian banks. And one of the things that's been particularly appealing is the taxes you pay on ETFs are taxes that were incurred because of you, as opposed to taxes that were in a mutual structure from someone else. I mean, think about it. Suppose you enter a mutual fund in 2018 and there's a taxable event, taxable gains to be paid. Those may be gains paid on the appreciation of, say, stocks from other mutual fund shareholders in prior years before you even entered the scene, and yet you're paying the taxes. Whereas with an ETF, you buy an ETF, it goes up, let's say, you take a taxable gain, you paid the taxes, it was on you. I mean, that's just common sense, and it's really the knock on the mutual structure, I would say. But of course, there's intraday liquidity, as I mentioned. If for whatever reason you feel compelled to buy or sell in the middle of the day, that's your prerogative. You don't have to wait till 4 p.m. Eastern time to get your fill, as you will with the mutual fund. And then, of course, there's potential hedging uses. Maybe you determine that your portfolio is too aggressive at any moment or too conservative, and you want to take the other side by plugging in ETFs accordingly. You can do that. So that's something that's particularly appealing. Now, this one, I really wanted to, I've been staring at this quote for a few months now. Bogle's been making quotes like this through the years, but I really want to kind of think about this for a second. Let's read this. As a long-term investment strategy, I don't think the index fund has any competition at all, says Bogle. And Bogle, of course, is the face of this industry, and Vanguard has taken in trillions of dollars. And, you know, I have family members with Vanguard, for example. And I think that Bogle is absolutely correct if we interpret the quote as being index funds relative to active mutual fund managers, because there's been so much compelling evidence through the years that active managers have had trouble, by and large, beating their benchmark. However, when he says index fund, does Jack Bogle mean here a market capitalization weighted index fund? A market capitalization weighted index fund is constructed such that, say, one company is $100 billion and the next company is $50 billion, and it's the S&P 500 or something like that. And then the $100 billion company will have twice the weight in the index of the $50 billion company. And those index funds, which are the classic index funds, have been able to essentially do famously relative to the active managers through the years, because you could drive a truck through the expense ratios. The MERs and the active managers have been so much higher than the classic cap-weighted index funds. But does he mean the index fund or index funds in general? Because if you consider what WisdomTree, for example, is doing, where we have index funds, but we have a smart beta, or what we call a modern alpha, tweak on those indexes to the point where now the market capitalization weighted index does have competition from other indexes. In fact, if the reason behind the active manager's struggle through the years was that it was such a wide MER gap relative to the index fund, what happens when there are smart beta / modern alpha operators in the business with very narrow expense ratio differentials that can reconfigure indexes in such a way that you can say eliminate companies that have negative earnings completely from the index, rather than having to include them just because they have any market value at all, which is what the TSX 60s and the S&P 500s of the world offer you. And so in this three-part world, the market capitalization weighted index, the modern alpha index, or the active manager, would he reconfigure that statement? And I would argue against Bogle, and I would say that the classic index fund does have competition, and it's borne out by the studies over the course of 50, 60 years that show that reconfiguring indexes to hone in on concepts like profitability, like value, like common sense, seems to be a logical way to invest through time. Now, something I wanted to point out, very specific to this country, very disconcerting, frankly. Now, you all know Morningstar as well. Morningstar is one of the best brands in the business. Their fund research is second to none. And every year they put out the Global Fund Investor Experience Study. They just released the 2017 one. Maybe it was in the summer or the fall. And just read this quote. And this is, this has been the case in the Canadian mutual fund business for so long. Canada continues to have an uphill climb. It's much to the benefit of the ETF business because it's easier for us to hammer home the fee argument. But this is just crushing. This is debilitating to have to pay MERs that are very, very high, and that, frankly, as you can see from the disclosure at the bottom of page 7 here, there was 25 nations in this survey, and Canada is the worst on the fee side of the equation. And if you take a look at the next slide, I really want you to consider this. Last summer, I was writing for our fixed income business. I was putting together some exhibits, and if you were to navigate to wisdomtree.ca, you can go and find our research and our literature on this concept and on others. And I was putting together some supporting concepts within fixed income, and I want you to consider this. This is the MERs in the mutual fund business and the ETF business for Canadian fixed income. And now, right now, Canadian aggregate bonds are yielding about 2.5%, and 10-year Canadian government obligations are yielding 2.2%. And yet, so many of us are out there paying, call it half, maybe even more than half of the yield to a money manager to manage a bond fund. And the thing about it is it's a bond fund. What can you really do within a bond fund to generate enough incremental returns over and above what just a passive basket of those bonds can do to justify, in this case, 70 basis points, 102 basis points, 130 basis points, or whatever the case may be on your fee side? Whereas on the ETF side, a lot of what the modern alpha money managers like ourselves, like others, are doing is essentially doing a lot of the tactics that mutual fund managers are, running value screens, stretching out credits, or stretching for duration, or whatever the case may be to get that incremental return that many of the active managers are also doing. Except because we're doing it from an index base rather than from having a high-paid army of high-salary professionals on Bay Street do it. We're doing it index-based oftentimes at fees that are materially different from the fees that you can see in the mutual fund world. And of course, this example is fixed income, but you can see it with your own two eyes as well. If you look at mutual funds, look at your own mutual funds on your statement, and then hop around the internet. Look at WisdomTree. Look at WisdomTree's competitors. WisdomTree is not the end-all, be-all. Our competitors are wonderful firms with desirable ETFs. I don't have an ill word to say about any of them. You know, think about those fee disparities and think about, can the active managers overcome those? Oftentimes the answer may be no. So I want you to think about what you would look for in the ETF providers. A lot of the big providers pass these tests, and some of the smaller ones may not. Some of the bigger ones may not. I want you to just think about them. I'm not here to name any names or anything like this, but I believe, and this is one of the reasons I crossed over to this side from being a money manager to being an ETF strategist, was because I was a client owning WisdomTree, and these 5 concepts, among many, were really what brought me over to WisdomTree. You have to ask yourself, what is the firm's reputation? Do you respect what the firm is doing? When you go to their website, is there a lot of well-written research? Is it thought-provoking? Are they thoughtful people? Are they throwing together ETFs because they think they can get hot money, or are they putting together ETFs that they want to keep clients for 10, 20, 30 years? These types of questions. No different from the types of questions you would be asking if you were purchasing a new car, right? Can I envision being a client from any why anybody would put together an ETF that they think might be hot for 2018 or 2019 to get a couple $100 million in really fast? That happens. You know it happens. But is that a key to a long-term business? So take a look. If you take a fancy to someone's ETF, take a look at all of their ETFs and ask yourself, is there any gimmickry in here? Or is this a business that's well-defined? Would a collection of finance professors seek this firm out? If those answers start to kind of fall in place for you, I think you come to your answer. And of course, you have competitive fees. The exposures, I'm going to talk in one of the upcoming slides about the exposures as well. And then, of course, the philosophies. I'm going to give you in a quick rundown some concepts that align with WisdomTree's philosophies. We believe in value investing, for example, typically. Typically, our ETFs tend to have a little bit of a value flavor. We believe in quality factors. We have a lot of ETFs that are screening for ROEs and ROAs and those types of things. Other firms, maybe they have more momentum orientation or more thematic than, say, some WisdomTree. And those might be the approaches that you're looking for as well. And so just think, what is your investment philosophy? And then go find an ETF provider that might have a philosophy that aligns with that. I'm probably going to skip over this in the interest of time. And I wanted to point out something that's specifically relevant for this country. And it's on slide 11 here, diversification. The thing about Canada, and we all know it well, is that it's one of the few exceptions within the developed world where there is sector concentration that is like an emerging market. The economy itself is not like an emerging market. It's one of the most developed economies in the world. But emerging markets tend to have just 1 or 2 sectors that dominate, whereas developed markets tend to have a broadly, I mean, think about the United States. There's 11 sectors, and they all hold some sway. But in Canada, really, you have the 2 sectors that are 2/3 of the index, right, the financials and the energy companies. And that's when you're heavy in Canadian equities, that's wonderful when financials and energy are doing well, right? And not so wonderful on the other side of the coin. And the thing about it is that Canadian equities as a percentage of global equities is 3%. So those 2 sectors are 2% of the global equity. So $1 out of every $50 in the world in stocks is in Canadian financials and energy. The other 49 out of $50 is elsewhere. U.S., Europe, China, whatever it may be. And yet in our business, that's approximately 140 billion CAD, give or take a few billion CAD. 1 out of $3 is in those two sectors. For better or worse, maybe those sectors go up, maybe they go down. But you need to ask yourself when you're selecting ETFs and when you're building a portfolio, how much diversification do I want? Okay, because you'll see that, for example, there's some individual companies in Canada that can be upwards of 8-9% of a TSX 60. You can go find that right on the internet. You can ask yourself, how much do I want of these correlated sectors? Should I be diversifying? Should I be looking at the U.S., international, developed, emerging markets, or so forth, or within Canada? Should I be seeking out ETFs that perhaps give me a broader diversification or complement existing concentrated positions within Canadian financials or energy? I mean, if you have 15 or 20-year-old cost basis TD or BMO in there, sometimes you may feel stuck with those securities. And if you go buy a mutual fund that is also holding TD or BMO, you're just increasing exposure to those individual firms. So just think about these concepts. Always think from a total portfolio perspective. And it's very hard for all of us to do that. You know, you have a portfolio, maybe there's 10 line items, and the one line item's doing the worst. That's the one you focus on. That's the one that gets you psychologically. But always be thinking from the whole, not the individual parts. Now, some other things you want to do when you're looking at ETF managers themselves is this aligns, I think, with the ETF manager philosophy. Do I believe that the firm itself is philosophically aligned with supporting their ETF business? Or was ETF business launched because, ETFs are gathering a lot of money, let's put together an ETF business really, really fast because that's where the money's going. I think that's one of the things that's pretty nice about WisdomTree is WisdomTree came into being in 2006 as an ETF company. You know, on the TSX, it's ETFs only. We don't have a mutual fund business in Canada. I mean, there's no legacy mutual fund business. We're pushing, I want to say it's 57 billion CAD in AUM across our global businesses, almost all of it ETFs. There's some UCITS as well over in Europe. What else do you want to avoid? I think you want to avoid chasing what's hot right now. And I think you turn on BNN and you turn on CNBC and you can kind of get a gauge for that. You know, you say, well, there's only, you know, X number of dollars in such and such industry or concept, and yet this is what they're spending all their time talking about on CNBC. Then you come back 2 years later, they're not talking about it anymore because it went away, whatever it may be. You want to avoid these things. You want to ask yourself, what would responsible long-term holders be thinking? And this is the types of things, this is how you build a portfolio. You build a portfolio with total global equity and fixed income concepts incorporated, right, as opposed to speculative ventures. And then, as I stated with the other chart, with that big bar chart, you want to avoid insularity. And this is something that's so peculiar, isn't it? Canadians are so worldly. So, I mean, you think about traveling, for example. The typical Canadian is so much more likely to have visited foreign countries than, say, a typical American. You know, Americans oftentimes will take a vacation inside the U.S. and maybe not go overseas. Or there's a higher propensity of an American to not have a passport than a Canadian, let's say. And yet, when we look at Canadian portfolios, despite its small makeup within the global context economically, portfolios can be dominated by Canadian equities, and then within those Canadian equities, dominated by specific companies. And so make sure that we keep in check the degree with which we are being too insular in our thought processes. And the last few slides, before we turn it over to some Q&A, really, what is smart beta? Now, smart beta is kind of the industry's terminology for what we describe as modern alpha. The reason we call ourselves modern alpha as opposed to smart beta is because, well, this is funny. I had a journalist, I never really thought about it this way, but I had a journalist a few weeks ago say to me, when I ask people why they don't like the name smart beta, industry people like me, why they don't like smart beta, their issue is usually with the smart problem. But Jeff, your issue is with the beta problem of it. Why is that? And essentially, well, first let me define beta. Beta is essentially how close you are to looking like the market. And it's a mathematical measure. And so if you are, say that beta in the United States is the S&P 500, and in Canada it's the TSX Composite, and you are tracking those, then you have a beta of 1. And then to the extent that you are not doing that, your beta differs from 1. It's either higher or lower. And I basically said, I have no problem with people calling my company smart. I think it is very smart. But what the issue is we don't want a client for 1 year. That does nobody good. It does the client no good, and does us no good. We want a client for 25 years, 50 years. And the way to keep someone, whether it's WisdomTree or whether it's the competitor, is to make sure that this level of trust and communication is wide open so that everybody's on the same page. And essentially, to the extent that you are deviating from that data, the more and more you deviate from it, the less and less you have a right to call yourself beta. And frankly, we didn't really want to call ourselves beta because we have some philosophical objections to market capitalization weighting, which again states that if Apple, for example, is 3% of the total value of the U.S. stock market, then it's 3% of the index. And who cares what money they might have earned or didn't earn last year? That's the way it's done. We have philosophical objections to that. We're saying we care about the dollar amount of your dividends relative to other people's dividends, these types of concepts. And so what we're doing is generating the other Greek term, which is alpha, which is the degree with which you outperform. That is what we are targeting and trying to achieve. And the way we do this, the way the industry does this, is one of these 4 blue boxes. We tend to fall into the 2 turquoise ones. And that's not to say that the 2 blue ones are wrong or that those aren't optimal. I have in my past life owned ETFs of both of those dark blue varieties as well. They have great underpinnings as well. WisdomTree itself just happens to fall into the turquoise areas. We're screening based on factors. We're big believers in the Fama and French studies, the academic studies. Jeremy Siegel from the Wharton School is a senior advisor to the firm, and so we've really believed in concepts such as dividend weighting, the power of paying money back to shareholders to show that management cares more about their shareholders than building corporate empires. And that over the course of 30, 40, 50 years, this is a logical way to invest. And so that's really, in a nutshell, the definitions of smart beta. Now, this slide, I'll just pass over this slide. This is kind of a boilerplate. You got this guy walking up the stairs or whatever he's doing here and talking about the difference between beta and smart beta. And before we go to the Q&A, I'll wrap with, who is WisdomTree? I mean, we've been around. This will be our 12th year. We've been in Canada for a couple of years. I was hired last year to really lead the strategy effort, the investment philosophy effort in Toronto. We're pushing up 400 million CAD in assets in Canada, and as you can see, as I stated earlier, our ticker symbol is WETF. And I love that that's our ticker symbol because there's nothing more clearly stating that this is a firm that was launched and believed and believes in ETFs than a firm whose ticker symbol has ETF in the name. We are the pure play ETF company. So we are very, very happy to be having this call with Questrade. Very happy to have met these highly intelligent people at Questrade and have this initiative going. And Jeff, at this point, let's go ahead and open it up to any questions And if there are none, we'll wrap, and if there are some, we'll see if we can address them.
Great, thanks, Jeff, and thanks for the incredibly interesting and educational presentation here. A great primer for those looking at mutual funds versus ETFs, and indeed how to build a balanced ETF portfolio. So there are a number of questions that have come in, so I'm just going to start firing them at you, if that's all right.
Okay, great.
The first one, there's just a little, I think, maybe misconception, which we might be able to touch on. Some people were confused. I think they didn't realize that ETFs were appropriate for long-term holding. Maybe they're referring to the leveraged ETFs or not. So I was just wondering if you could shed a little color on sort of maybe the like categories or families, kind of broadly speaking, of ETFs to sort of explain that, whether these are appropriate long-term investment vehicles.
Yes, the thing about a long-only ETF of the type that WisdomTree has in Canada is that they can be used anything from the short to the long term. If you think about an ETF, some people are day trading ETFs, and others are buying them and going to sleep and owning them for many, many years. Now, the leverage ETFs that were mentioned here tend to be used by people with a more shorter-term horizon because there can be some decay based on the mathematics of multiplying the daily returns. So I've come across not too many people using the leveraged ones as a long-term horizon. We don't have any leveraged ETF business in Toronto on the TSX. But what the leveraged ETFs are, so that people understand what they are, because there are some other firms providing those, is, for example, say you have a levered ETF that says it will give you 3 times the TSX 60. Let's say that's something that somebody would have. Then what those will tend to do is give you 3 times the daily return of whatever happened to the TSX 60. So the TSX 60 went up 1% that day. The ETF would tend to rise about 3%. And so it gives you magnified returns to the upside and downside of whatever it tracks. And we don't have any existing business in Canada for this.
Gotcha. Thank you. No, that's quite helpful. Another question that's come up here from our Canadian investors are wondering, are there ETFs that you can buy that give exposure to U.S. or international stocks but kind of hedge out that currency risk? Is that something that exists out there?
Oh, yeah. It exists at WisdomTree. It exists much more in Canada than in other markets, and it exists at WisdomTree's competitors as well. One of the reasons that the TSX-listed ETFs tend to be much more currency hedged back or unhedged is because Canadians are much better versed in understanding Forex than, say, Americans. So, for example, in the United States, the American stock market is about half of the international stock market, of the global stock market. And so many Americans will hold solely U.S. equities and never have to think about Forex. Whereas Canadians typically will oftentimes, you'll come across many Canadians owning U.S. equities. And if you anecdotally, I mean, I'm back and forth between the two nations. If you pull an American off the street and say, what's the exchange rate with the loonie right now? They may say, what's the loonie? Whereas if you pull the Canadian off the street and say, what is the exchange rate with the greenback? They know it with a penny. It's just part of, it's just part of knowing, because you own U.S., you vacation in the U.S., whatever it may be. So hedging currency back in an ETF structure is very, very common. WisdomTree does it essentially across the suite in both the U.S. And international developed, as do rivals. It's common to find rivals having the international exposure hedged back. So it should be no issue at all to find ETFs that are doing that.
Excellent. Great. No, that's very helpful, and I think something people were excited to hear. So another question here as it relates to fixed income. It seems as though a number of people on the call have some fixed income allocation in GICs currently, and they're wondering, if the market, is it possible that a bond ETF would, maybe lose its value, whereas should interest rates change or something, whereas the GIC would maintain its value. I was wondering if you could maybe just speak a little bit to maybe some of the pros and cons of bonds, ETFs versus maybe some other fixed income instruments that people might be reliant on.
Yeah, and one of the things about fixed income in general, and this would apply to a fixed income ETF or a fixed income mutual fund, is that yes, in the event that interest rates rise, the value of those fixed income securities, unless they were floating rate, would decline. And then if interest rates decline, the value will appreciate. So yes, should we encounter a rising rate environment, then there would tend to be a headwind for fixed income securities.
Noted. No, thank you. Okay, just two more quick questions here before we wrap up, Jeff. I don't want to keep you all afternoon, and thank you again for your time here.
Glad to answer.
I don't know if this one is tongue-in-cheek or not, but a couple of people have asked, what are mutual fund companies going to do? Do they have to lower fees, or should I move my mutual funds to ETFs? What do you see happening there on the horizon?
Right. Well, you always want to consult an advisor or a financial professional that's in those types of situations. But you have to make a balancing act between where are you philosophically between the mutual fund and ETF concepts. I think that to answer the former question, that the mutual fund managers have been, over the course of the last couple decades, cutting their fees, but at a snail's pace. Mm-hmm. It's just a degree it's a question of how much they want to make the business decision to protect lucrative profit margins or gain market share. So if we have a situation in which the stock market is not appreciating at quite the same extent, or say it chops sideways, then their total assets under management will no longer go up. I mean, even if you have no net inflows or outflows, but the stock market goes up, your business actually expanded that year, even though you didn't attain any new clients. That's the thing that's peculiar about money management. So should the stock market chop sideways, or should it decline and they start to see more money go into ETFs, for example, it's just going to be a question of what they want to do strategically for their businesses. Now, in terms of switching over from a mutual fund to an ETF, you'd have to consider your tax implications as well. But take a look at the fees of your underlying mutual funds, and think about all the ETF providers as well. We would hope that people would consider WisdomTree, but go ahead and take a look at everyone, because we're very proud of the industry in general.
Great, perfect. No, thanks for the commentary there. I guess last question, and you don't need to answer it too specifically, but people are, as you mentioned, sort of the market's been going up. It's stocks, mutual funds, ETFs have all done quite well the last year. For those people that are looking to invest for the long term, is now a good time to start, or should they wait, maybe for things, for a correction or something? Do you have any thoughts sort of on that?
Yeah, so it's a macro question, the macro outlook question. Yes, there's a few things going on with respect to Canada specifically. I mean, obviously we have the Bank of Canada now tightening policy. I wouldn't say considerably, but certainly relative to the other central banks, we could use that word considerably, because the European Central Bank and the Bank of Japan have not started to tighten policy, and it's essentially just the Canadians and the Americans that are doing it at this point. However, the gap between, say, an earnings yield on an MSCI Canada type situation